understand exactly what it takes to build a business. And we have a very, very unique business that I've never seen before in all the years I've been doing this. I'd like to introduce to you Justin Kaiser. He's the co-founder and visionary of Solar Equity Group. And also, we are very fortunate to have the IRS enrolled agent, James Harnsberger. It's also going to get into more of the technical details of why we have been able to put this all together for everyone and to be able to share this. So a little bit about Justin. As I said, he's a visionary. He's done radical visionary changes and in the existing tax equity business model currently used by the industry in the last 6 years. The result has brought together leading industry experts in both the solar energy and tax professions and is proving to be vastly more effective in funding solar energy companies nationwide. Prior to this, co-founder of Solar Equity Group, Justin founded multiple domestic companies, including FinTech Credit Restoration Company, business funding, and both REO and real estate investment firms. He's also founded multiple international companies in Belize, British Virgin Islands, Navies, New Zealand, all over the place. I'm really impressed myself. So without further ado, I'd like to introduce Justin. Take it away, Justin.
All right. Well, hey, Gary, thanks so much for the warm welcome and introduction. And welcome to the webinar, everybody. I am Justin Kaiser, one of the co-founders of Solar Equity Group. We thank you for taking the time out of your busy day to jump on this webinar with us and learn a little bit more about what we're doing. And I just want to get started by talking about a major problem that we're all facing here in the United States. It's a quiet problem that virtually nobody is really even talking about, and that's the fact that our nation's power grid is a disaster that's just waiting to happen. It's outdated and it's centralized in a way which makes it extremely vulnerable to natural disasters and terrorist attacks. I mean, just a few coordinated strikes on our power grid could wipe out most of America's power supply and leave us with an economic collapse. So what we're doing with Solar Equity Group is being proactive about this. We're taking a stance and we're helping to fund solar energy projects through practical economics. And what we're ultimately doing is actually advancing a commitment that Congress has made to the American public of having at least 20% of America's power being generated by clean energy by the year 2030. And so there's an opportunity here to participate by helping. And what you're basically going to be doing is executing a capital contribution agreement with a solar energy company and taking on the role of a general partner in the actual solar energy company itself. And we're very, very appreciative and very excited to have our main guest on the line with us today. His name is James Harnsberger. He's an IRS enrolled agent. Now, what that means is that by definition, he is a tax expert. Now, there's a lot of qualifications that IRS enrolled agents have to go through in order to become qualified. And not only is he an IRS enrolled agent, he's also an NTPI fellow. So I'm going to go ahead and allow James to explain this opportunity, how it works as far as tax reporting and everything. But I just want to let everybody know that we're so excited to see so many people that's wanting to help us spread clean energy throughout America and really help the whole planet as a whole. So without any further ado, Mr. Harnsberger, are you there, sir?
I am. How are you, Justin?
I'm doing well, James. Thank you. How about yourself?
Doing very well, thank you.
Great.
So I guess I'll start. Yeah, where would you like me to start?
You know what? I see some questions already popping up, but basically, you know, if you could just kind of talk about just the mechanics of this and how this works as far as clients are becoming a general partner with an actual LLC, and by doing that, they're going to reap some extreme tax benefits. So maybe we just start with that. And yeah.
All right. So my role really is to assist in just sort of the technical side of the tax reporting so that people understand or have a better understanding of how this all works. if you want to start out at the high view, you have a solar energy company that provides the installation of solar equipment.
Stay tuned, everybody. I think that we lost James. Well, we'll see if he gets back on here.
Yeah, it's one of those things where he's probably still going and thinking everybody can hear him.
That's exactly why I sent him a text. I was pretty sure of that. So
right.
yeah.
Well, at least you proved this is live.
Without enough, folks. There's no script here. Everything
That's right.
is done on the fly. That's how we like it. We're real people here. We're not hiding behind a website, and we're extremely excited about this opportunity because, like I mentioned, there is a major problem going on here. I mean, America is powered by less than 15% clean energy right now, which puts us way behind the rest of the planet. I mean, you look at Germany; they're at 78%, and so the rest of the world is pointing their finger at us and being like, "What are you guys doing?" And so somebody needs to really step up and expand this agenda and this commitment that Congress has made to the general public. And we feel that with practical economics and with the opportunity that we've put together,
Right, sorry about that.
we believe we can. So James is back, and I'll let him take it from here.
Yeah, I don't know what happened. I'm sitting here minding my own business, and the whole thing just cut me right off there. So anyway, if you have the solar company, they're going to put the equipment on the building, the solar equipment. What happens is generally the solar company will put a certain amount of money down to secure that equipment, and then they will finance the cost of the remainder of that equipment for that project. And usually those finance agreements have a continuation life of 25 years. Now what happens is that because of the tax code, the way that works is the solar company takes the cost of the equipment and depreciates it using accelerated depreciation to take the acceleration of the equipment cost. And if the solar company in that year, that generates a net operating loss. That net operating loss is equally divided amongst all of the partners in the LLC, proportionate to their interest in the LLC based on their capital contribution. And to keep it really simple is that if you have 10% of the partnership and the loss is $1,000, then you get $100 of that loss. And that passes through on a K-1 to your tax return, and it becomes an ordinary loss, which I'll get to in a moment. The typical tax treatment requires that this depreciation be recognized in that fashion. And what happens is that you've made a capital contribution to become a partner, and so your position for the capital contribution, if there's a shortfall, that is made up to equal your basis for the losses. That's made up in what is called recourse debt that was financed. But because your continuation agreement is reverting back in 6 years and the financing is 25 years, then those two sort of don't line up in the same time that your agreement would be reverting back. When you're talking about the net operating losses as a member of the LLC being ordinary, typically some of the confusion comes from tax professionals that might have the understanding that the losses would be treated as passive under the active material participation rules. These are covered under Section 469 of the Internal Revenue Code, and to make that ball of spaghetti a little bit easy to understand is that those rules don't apply for a couple of reasons, not the least of which is are three cases that were decided in 2009 that the tax court and the U.S. Court of Claims had decided regarding the tax treatment of a member of an LLC in this kind of a situation. You're not a limited partner, and the applicable rules of the passive activity loss rules or material participation rules do not apply in this situation based on three court cases. One is the Gregg case, G-R-E-G-G. The other is the Thompson and the Garnett decisions. Basically, this was a three-legged stool that these three cases decided the issue with regard to the tax treatment of a member of an LLC is not that of a limited partner. The tax treatment of 469 doesn't apply in that circumstance to somebody that's a general partner, and then the passive activity loss limitations do not apply because 469 and the temporary regulations would be rendered obsolete. So you get a K1, you're an ordinary loss status as to those losses because your status is a general partner, and your capital contribution is made up based on the agreement that you have with the solar company in terms of making that capital contribution to the solar company. When you file your return and you have that loss reported on your return, the law also provides that if there is an excess loss greater than the income on that particular year, let's say 2016, then you can elect to carry back the excess losses to the two prior years and apply those to your taxable income. And then, of course, you would recover all of the tax refunds for the income taxes paid in the two prior years. And so, simply stated, it is technically correct and it is accurate in terms of the tax treatment, and really it's just simply a matter of the K1 and how it gets reported on your tax return and how those losses are carried back under the provisions of the tax code. There's one other aspect to tax credits that are energy solar credits, and those are based on a current and forward-looking situation where you can actually use the 30% of the equipment cost that the solar energy provides through legislation that allows those tax energy credits to pass through to all of the partners proportionate to their percentage of interest in the LLC. And because LLCs are not deemed to be partnerships under state statute, then again, the applicability of the passive activity or material participation rules do not apply. And going back to those three court decisions, that's the correct tax treatment and the correct tax reporting structure. Does that pretty much frame it correctly for you, Justin?
Yeah, it does. Yeah, you did a very great job of explaining that, James. Thanks so much. Some of the questions that we get a lot is, one of them in particular is, what's the risk involved here? What is the risk for somebody that's becoming a general partner of an LLC? Can you touch on that a little bit?
Well, in terms of the financial risk, they're like any other general partner, except that the only risk that they would have would be the recourse debt, and since that has a life of 25 years before that is due, and their agreement would revert back to the LLC within 6 years, then there would, that risk is basically negligible.
Correct. And the fact that it's an LLC, I mean, it's limited liability by definition. So that.
Well, again, and that's a separate issue. Yes, the limited liability status is not lost because you're a general partner. And particularly these three court decisions made that clear that you still maintain your limited liability because there's a managing general partner as opposed to a general partner, and that's governed also under state law.
Right. Yeah, absolutely. James, for the CPAs and the enrolled agents and the other tax professionals that are tuning in today, what is something you can tell them? What is the reason why you decided to get involved? What was so attractive to you for you to spend as much time as you have with us and dive into this with us?
Well, I think the main thing is I wanted to satisfy my own curiosity. How does this work when, on the face of it, it appears that this would be an active or material participation, passive activity issue? And after doing the research and finding out that those rules do not apply and that they are rendered moot because of these 3 court decisions, I think many tax professionals would be under the impression, like I initially was, or like Malcolm, our CPA, was, that these losses, to the extent that they pass through, would be suspended because of the passive activity loss treatment under Section 469. And once you really unpack that and do all of the research and discover that in this particular case of facts and circumstances that doesn't apply, then you can easily see, and that's why we wrote the short memo and memorandum and give an example of how it works in terms of the outside basis issue. Because if your losses are greater than your capital contribution, they would be limited based on your capital contribution. And so if you had $500,000 of loss and $100,000 of capital contribution, typically you'd only be able to use 100 because that's your basis. However, you have debt basis because the debt is recourse debt, and that is the financing arrangements that the solar energy company makes. But because that's a 25-year call date and the interest in the LLC reverts back in 6 years, that sort of answers how that all works in terms of the basis issue. So I think to answer those questions, they would simply just ask you to send them a copy of that short memo that we put together that explains the 3 cases and gives an analysis of how the outside basis computation would work. And I think any fair-minded tax expert or CPA would easily be able to see how that's all reconciled.
Great answer there, James. Thanks so much. We're just going to kind of take the questions as they come in here. I see that we've got one coming in here from Jan Edwards. Looks like she's a tax professional. She's asking a question about whether, well, actually, James, you just covered it. It was all about the active and passive laws and about the 500 hours. So, okay, Jan, hopefully that clears everything up for you. We'll make sure that we get that PDF over to you after this webinar, so stay tuned for that.
Yeah, the 500, just to touch on that, the 500-hour material participation is moot because of the decisions in those 3 cases. All of the provisions of 469 and the temporary regulations do not apply, and that's from 2 tax court decisions and the U.S. Court of Claims, and those are rendered obsolete when applied to LLCs and their members.
Perfect. All right. And looks like we've got another question coming in here from Jeremy S. He's asking about does this create a gain for the client, James, or for the general partner once they go through this process? Is this something that they have to claim and pay taxes on?
No, the only time that there would be a potential for gain would be the amount that they don't pay in the capital contribution to the solar company. There might be, let's say that you're keeping 10% of a refund. That could be potentially reconciled as an amount of gain. But if you'll look at the reconciliation that we did in the memo and how you make the adjustments, you can clearly see that those issues are resolved based on the capital contribution, the adjustment on the NOL, and the amount of the recourse debt, so that it doesn't trigger an income or a gain issue.
Perfect. Okay, thanks for that. And got another question that's came in here. Looks like from Shirley out of San Francisco. She's asking if when somebody becomes a client, if any of their past if they have any liens or anything like that, what exactly happens with if they would go through the process, or is there something that we do to mitigate against that, or how does that work?
I'm not sure I even understand the question.
Oh, well, okay. Let me read this a little bit in depth. If somebody has a tax lien, or if they have any other kind of a lien against their taxes, are they able to go through this process and help clear that up, or do they have to be completely current with their tax years?
So a net operating loss that's an ordinary loss generates negative income, and any tax liability for income taxes would be eliminated. And to the extent that a person had a tax lien, that would mean that they have taxes that are owed and not paid. And that lien for income taxes would be a valid lien. The issue with respect to how the tax treatment of the NOL is that if it were income taxes that were not paid, and then you had an NOL on your tax return that wiped out your tax liability because of that NOL, then you wouldn't owe those taxes either on a current year or a carryback year. If the tax lien was generated from other civil penalties or other types of taxes, employment, self-employment tax, or employment taxes, that's a whole different kettle of fish. But generally, if a tax lien is filed, that means that you have an unpaid liability, in which case there would be no refund. You just wouldn't have a liability for the income tax portion.
Right, and Shirley, to further expand upon that, for one of our requirements for clients of Solar Equity Group is everybody needs to be current on their taxes. They can't owe any money for 2015 because the way the capital contribution works is 90% of your refunds are actually going to capital contributions. So now what we will do is we will help you moving forward. So any estimated tax payments that you've got that you would like to make as capital contributions, you can move forward that way. But unfortunately, we wouldn't be able to do the carryback in those cases because of the amount that's owed until you got current, and then we could take you on as a client. So hope that pretty much explains everything between James's answer and mine. All right. I don't see any other questions here. James, is there anything else that you want to touch on, or Gary?
Yeah, just add one final point, is just to make sure that, when you're looking at how your participation as a partner in the LLC is one side of the transaction, the technical side, and really where my role is really to be available, is to help at least everybody understand the process and the procedure of how that gets reported on a tax return, how the carrybacks work, and to try to be there and answer any questions with regard to the technical tax treatment. Every case is different, every situation is different, and if you're working with your tax professional, they're going to have a better idea in terms of, your nuances and circumstances. But in terms of the straightforward, this is how it works, and this is how it's supposed to be computed, we've done a pretty good job at vetting through and talking with the person that works with a solar company to make sure that each project and how those K1s come about, and have done a pretty good job in vetting through that information. And, I think the only sad thing is that more people don't know that they can participate as partners in an LLC and help advance the causes of solar energy and get a tax benefit in the process of doing that. So that's I think it's a great opportunity.
Excellent. Thanks so much, James. We really value your expertise and everything that you bring to the table as far as vetting everything out and being available to work with the CPAs and the enrolled agents and the other tax professionals that we bring on board. So thank you for all of that. Gary, is there anything that you want to add before we wrap this up? I don't see any other questions coming in.
Yeah, I have a question. let's say that we have a CPA or a tax accountant or an IRS enrolled agent that says, I'm ready to go. I'm excited. What's the next step? What paperwork do I need, or is there a manual to help me with with my clients to get started? And really, what's the next step? Who do I contact?
Well, what we would do, Gary, is we would set up a phone call with James, but that would be after they receive the PDF that he's already putting together for us, which is going to basically take away probably 90% of their objections right away, and then if not all of them. And if they've still got questions after then we'll certainly line up a call with James so they can ask those questions directly and get those answered. So those would be the steps.
Okay. Okay. That's what I was wondering. Thank you.
Absolutely.
All right. Well, very good, Justin. Thank you so very much, and look forward to talking with the folks as they have a need.
Absolutely. Thanks again, everybody, for taking the time out of your day here, and we look forward to seeing you on future webinars, and we look forward to seeing you as a client or a tax professional, and we'll talk to you guys later. Our next webinar will be Thursday evening at 6 o'clock Pacific time, 9 o'clock Eastern time. So stay tuned for that, and we'll see everybody soon. Bye now.